Hello students, welcome to the analysis session of the pre-seen document for December 2025 session. We will have a deep analysis of this organization Levwell Plc, which is operating in a hoteling industry, which is a sort of connected or rather a part of a broader tourism industry in the country of Essland. It is a very interesting scenario, an organization which is working in a very tough situation, even though it is doing well in some areas governance wise, but still, as it is a very competitive industry, they are facing different issues. And I believe a very balanced uh, paper can be expected from this scenario, from this pre-scene. So let's get started with it. First of all, we will go through, as always, we will go through the industry profile, and afterwards we will go through this organization in question, that is Levwell. Okay, the industry, it basically relates to the situation where we have different hotels which are rated on 1 star to 5 star, 5 star being the highest eminence and the highest quality and providing highest level of services. There are multiple uh, hotels in varied categories, and we will go through the requirements of to be graded a hotel to be graded as 1 star or 5 star or anywhere in between, and there is a complete list of the facilities that hotel has to offer in order to qualify for that particular star level. So let's get started with broadly. There are two types of guests that utilize the hotel services. One are the business guests, and the other are the leisure guests. People who are leisure guests, they are very price sensitive, and there is a big risk involved in this area. And later on, we will have to see what is the percentage of leisure guests to business guests overall. But if we are primarily relying on the leisure guests, they are very price sensitive customers, and therefore there will be high vulnerability if there is a downturn in the economy, which there is in Essland, and definitely that will affect our profit margins, which are already very thin, and it is a very competitive industry. The rating quality in this industry is 1 star to 5 star system based on room sizes, services, and facilities. Our focal organization, Levwell, it operates as a 4 star hotel. It is a chain of hotels which operates as 4 star segment. While operating at 4 star, and this is going to be one key, operating at 4 star requires high standards of service and specific facilities, for example, leisure centers, food and bar, increasing complexity, and then cost relative to the lower tiers. So our profit margins will be very difficult to maintain, and because these facilities need a lot of maintenance and a lot of input in terms of costs and efforts and time of the management. Then what is the market structure? There is a mix of chains, which is standardized brands which are operating as owner operated or franchised. And then there are some independents as well, which offer flexibility and unique experience. There is high consolidation trend through chains acquiring independents. Therefore, based on this, the analysis is that there is intense competitive pressure among chains. Consolidation increased the threat posed by the scaled competitors who benefit from streamlined operation and bulk purchasing. Now, there is organic growth by hotel chains as well as they go for franchising. So we could expect a comparison, or we could expect a further strategizing for Levwell in this area. What are the financial benchmarks? Revenue typically is 60 to 70% from the rooms and 25 to 35% from the food and beverages and food and drink bars. Now here the profit margin is low, so there is a lot of pressure. Operating margin across Essland hotels is typically around 10%. This implies high operating gearing and low tolerance for errors and or rising costs. So this is a very important area that you need to keep in mind wherever you are proposing or you have to propose in the exam any thing which is cost bearing. You will have to consider that it is already a very tight budgeted or tight market in terms of costs. Okay, this is the overall, this is the snapshot of what is provided in the pre-scene. The facilities, for example, now if you compare one-star hotels, they only have the guest rooms available, least of the facilities, and obviously business clients will not be interested in these ones. On the other hand, five stars are those which have all the facilities available, from guest rooms to private bathroom facilities, breakfast, restaurant and bar, wide range of amenities in guests, for example, television, ironing, etc. Leisure facilities for guests, for example, swimming pool, fitness, and this is the point where our organization, four-star, will end. They are not providing world-class luxury, for example, personalized services, chauffeurs, fine dining restaurants. And so this is the area which we cannot compete with others. On the other hand, with the three-star hotels, which will provide a big competition, we will see there is only one facility that is not provided by the three-star hotels. That is the leisure facilities. Otherwise, they are doing fine on the other fronts. And we could see that these activities, even though these are termed as leisure facilities, but primarily these could be used, and because these will be high-end services, these would be used by the business guests as well. And because these would charge higher, therefore, and on the other hand, we say that the leisure guests are price sensitive, maybe they will not be utilizing these facilities much and they will be preferring more of three-star hotels than four-star hotels. On the other hand, what are the market leaders? Unfortunately, according to this data, we Levwell do not fall in any of these categories. The five largest hotel chain in Essland accounted for 23.1% of the total supply of hotels in rooms. Of the total supply of hotel rooms in 20x4. Some of these chains can use an owner-managed model. They use an owner-managed model, while others use a franchise model. So this is going to be of some importance because we see 3 out of 5 are used by franchise. That is quite an achievement, I would say, because when we gave out a franchise, there is always a risk of lack of control over the franchisee by the franchisor. So it seems that they are doing quite well. Best on 3-star, 3-star, and 3-star. So the top 3 in the top 5 are the 3-star hotels, and the next 2 are 4-star hotels. So this gives us a lot of input to play with. That is, it is going to be a major challenge, we being in the 4-star category and not being in the top 5. They have Best on has the highest number of hotels, 504, and down to the 90. Then number of rooms in hotels, total, obviously they are the highest. So they have the highest number, and that relates to here as well, 150. Okay. This seems to be quite a great deal of a great market leader, because it is an owner managed one and it has the highest number of percentage of total hotel rooms in overall country. All right. So digging further into detail of what are the major industry challenges that everyone is facing, and we would see that a lot of PESTEL and Porter's 5 forces model discussion can be included in here. There is intense competition. What are the challenges? Hotel needs to find ways to differentiate themselves from competitors. So differentiation is required to attract and retain guests. The industry structure is characterized by intense competitive pressure fueled by consolidation. That is, chains that are buying independent hotels, and then organic growth as well. This rivalry forces operators like Levwell to constantly enhance their value proposition, such as superior guest experience, service quality, and you see, both of these will be related to our people or the workforce, and we will realize there is a big issue of our employee turnover. So this is one area that we can look into from exam perspective, that some recommendation may be needed for you to explain in terms or give in terms of how to improve the this issue and reduce turnover. Okay, to avoid price falls. What is there is an economic downturn in the economy, and that gives a lot of issue to overall industry. Essland has experienced an economic downturn, leading to a fall in demand for hotel accommodation, particularly from leisure guests. Why? Because they are price sensitive. And globally, high inflation reduces the public's willingness to spend, further reducing demand. What is the analysis? Since Level's primary target market is leisure guests, the company is highly vulnerable to fluctuations in discretionary spending and overall economic health. This economic pressure means maintaining pricing without sacrificing occupancy becomes exceptionally difficult. With that, because of the economic downturn, we have rising costs. Hotels must regularly maintain and renovate properties. And we will see that our strategy is every 10 years we have to have a major renovation. But even not, if we do not consider that, regular maintenance, usual maintenance costs a lot. And that is a must, that is not optional to meet guest expectation and comply with the health and safety regulations. So both of these are a very important area. Despite the downturn, high inflation remains a problem in Estland, leading to rising costs for maintenance, renovation, and energy. And that gives us a rather even more difficult situation to deal with. Given the typically low operating profit margin in the industry, which is around 10%, cost inflation poses a significant threat to profitability. Now, we being a four-star hotel and like we level, which require extensive facilities, which requires rising energy like pools, etc., maintaining maintenance cost and particularly burdensome. Now, further, a major issue in the industry is staffing. Hotels face significant recruiting and retraining staff due to high employee turnover, relatively low pay rates, and antisocial working hours. Obviously, we are running a hotel, and yes, that there will be prime hours or less prime hours, but hotel staff have to be in a greater quantity or a lesser quantity, but available round the clock, 24/7, like we call it. They will have to be available on the weekends. They will have to be available early morning, late nights. Now, yes, we will have a certain shift pattern, but still that creates an issue. Now, this is a critical strategic risk, people risk, and I have put some risk here, even though they have given the risk register at the end, but I have picked up different points and put it here. Several service quality is listed as a primary success factor for hotels. So, and it is directly related to people. And the high turnover levels turnover rate is around 39 to 41%, which is very, very high. It directly undermines the ability to deliver the first class service level promises in its values. Now, they have promised, they have a, in the last, second last page of the your pre-scene, they have promised an excellent service for the customers, which is not possible with this turnover. Obviously, when you have such a high turnover, even if you are able to hire new workers, they will need time for training, and during those training time periods you will have a serious problem with the provision of services to the guests. Constant training and recruitment cycle imposes a high operational cost and inconsistent service delivery. Then this is a season based business. We have a higher peak in the uh, winter season. Demand for accommodation is highly seasonal, especially for leisure guests. Hotels must develop strategies to attract guests, manage variable cost effectively during peak hours, off peak hours. Sorry. Seasonality complicates resource planning and necessitates careful financial management to ensure liquidity during low demand periods. For Level, the peak seasons run from it's about not September to March, it's about October to, let me reconfirm, there's a little bit of mistake here. Yes, it is October to March, and then off is from April to September. Okay. So, with the off-peak season requiring specific attention to maintenance and the occupancy level, what will you do with the staff in those areas? Maybe that is one reason that if you are hiring on a ad hoc basis, therefore your turnover is already is high. Now, revenue management and pricing. Maximizing profit requires hotels to balance competitive pricing with maximizing revenue. Finding the right balance between the charge for bedrooms and occupancy achieved is complex. Now, this point is the necessity of sophisticated yield management, which uses data analytics to adjust room prices in real time based on demand, occupancy. Failure to adopt dynamic pricing, as suggested by Levwell's relatively rigid annual pricing policy, we'll see it later on, leads to foregone revenue opportunities during high demand and unnecessarily low profitability during low demand. Now, this is a key area that you need to remember, that they have a rigid pricing policy which is applied throughout the year. Then we have the threat for new business models that are arriving. For example, Airbnb, which is very common. The growth of home sharing service, where people rent out private rooms or homes, increases the supply of available accommodation, acting as an alternative to hotels and reducing traditional hotel living. And this is uh, actually working on global level. Home sharing services represent significant threat of substitutes, which is from Porter's five forces. They offer high flexibility and often lower prices, obviously, compelling traditional hotel chains to focus heavily on aspects the substitute cannot easily replace, such as formalized security, extensive facilities, food and bar, fitness. Obviously, these cannot be provided by Airbnb type of services and professional service quality. Now, the problem is that these are only, according to the chart, excuse me, only provided by the five-star hotels, and a bit of it could be expected from a four-star hotel, but they have to look into it. Sustainability. Society is highly concerned. So there is a social area concerned with the environmental issues like carbon footprint, energy consumption, and waste. Hotels must implement sustainability measures such as reducing energy usage and encouraging recycling. Environmental concerns are also lead business guests to reduce travel, for example, opting for virtual meetings, negatively impacting the demand. Then, what is the analytical details here? Sustainability is both a cost factor because it requires investment in infrastructure, in sustainable development, maybe solar powered options, and a competitive requirement. Level acknowledges this trend through its values, stating that responsibility involves acting in a socially responsible manner and assessing supplier environmental credentials. Failure to meet sustainability, and here we will look further later on, you will analyze that we have most of this sourcing is done locally, and there is a proper mechanism with the level to ensure that the vendors are providing properly sourced, sustainably sourced raw materials to them. So, expectation risk, both reputation damage and loss of conscious corporate clients. Then we would see that there is a lot of innovation and business development going on in the industry. There are three areas that have been explained in the pre-scene. First is automation and technology. uh, what is the focus? It is to respond to guest demand for speed and convenience. What are the different developments? Hotels are increasingly offering options for guests to use mobile devices and apps for checking in and checking out. Applications are also provide convenient in-room services, for example, ordering food and controlling environmental setting, and utilize software like chatbots, artificial intelligence, or AI to provide instant answers to frequently asked questions. Now, while industry is embracing these digital self-service tools, we are not. Level's current operational involves manual data entry during check-ins, and company relies on in-house servers, not cloud, suggesting that they may be lagging in implementing the cutting edge and automation needed to maximize speed and convenience. And again, being a four-star hotel, is this expected of them? Well, actually not. Then is the yield management, finding optimal balance between revenue and occupancy. Yield management software use data analytics, including algorithms that draw on historical information, demand, seasonality, etc., and current market condition to adjust room prices. And this again is an issue because we use the annual one dynamically in real time. When predicted demand is high, prices are raised to increase profit margin. When demand is low, prices are lowered to encourage occupancy. So there is data analytics involved in this. Yield management is essential for successful revenue optimization in seasonal competitive industry, which this is. Level's current pricing policy, which sets prices annually and only allows local managers limited discounting authority, which is up to 25%. And this could also be an issue. It may be on the higher side. During off-peak periods, implies a failure to fully utilize this sophisticated real-time technology. This limits Level's ability to maximize revenue PR. Okay, now we could be expected to suggest different strategies, but it could lead to change management as well. Third is the sale and lease back option for different business uh, assets, providing liquidity and alternative financing options in challenging conditions. This emerging trend involves a hotel company selling a hotel building to a new owner in exchange for an one-off payment and then immediately leasing the building back. The company continues to operate the hotel but makes monthly rental payments to the lessor. Now, what is the while this arrangement boosts immediate cash flow, it converts the capital asset into a fixed long-term operating liability, which we will have to pay rental payments. This increases the company's financial leverage and fixed costs, potentially raising operating risk if economic conditions worsen. But Level currently uses an owner-managed model only, which avoids these fixed rental costs. So this could be a positive end. But maybe under certain circumstances, maybe if there is a possibility of a future increase in the economic situation, that could be a possibility for improving our capital boost. What are the key performance indicators in the industry? The occupancy rate measures the capacity utilization. A rate above 70% is considered good, and we fall actually into good category. Average daily rate, average revenue per occupied room tends to be higher in urban and major city hotels. Revenue per available room, revenue per, calculated as occupancy percentage multiplied by ADR, the primary metric combining volume and price. Average length of stay, a very important area because maybe the guests, the more they stay, the more they will pay, obviously. So the total number of nights booked divided by number of bookings, shorter stay are less profitable. So this could be one area that we could look into from our own organization's point of view. Guest satisfaction score measures the quality of guest experience from 1, which is poor, to 5, which is excellent. So this could be easy to remember from just like 1 star to 5 star. Employee turnover, a major area and a major problem for the whole industry, percentage of employees leaving during a period. All right. Now, there is a concept of industry body. Unfortunately or fortunately, that could be considered and argued from both perspectives. Well, Essland does not have a dedicated organization for hotel industry. What do they have? One, which is Visit Essland. It serves as a representative body for the broader tourism sector. Therefore, in the beginning, I said that we will consider hotel industry to be a part of the tourism industry. There are pluses to it as well, which includes hotels. It is a government-run public sector organization answerable to national authorities. Its main duty includes promoting tourism within Essland and marketing the country internationally. It works to enhance tourist service, including conducting hotel inspections as part of quality assurance. These inspections use standardized criteria to assign star ratings, helping guests understand the level of service and facilities offered by the hotels. Now, what is the strategic importance of Visit Estland for hotel business? If you recall from Porter's diamond model, there is a concept how government could support different areas. This could be linked into that. So first, governance and accountability. As a public sector body accountable to national government, Visit Estland provides a structured governance framework that indirectly influences hotel standards and operations. Hotels benefit from alignment with the national tourism strategies, which can enhance legitimacy and stakeholder trust. Hotels inspection, quality assurance, hotels inspections by Visit Estland serves as a formal quality control mechanism. Standardized star rating help build customer confidence and reduce information asymmetry, which is crucial for reputation and competitive positioning. On the flip side, we cannot we will have to be very careful on the compliance issues when we are focusing on our guests, especially those coming from abroad. Marketing and international visibility. Visit Essland promotes the country globally. Indirectly marketing hotels is a part of the national tourism offering. Hotel gains exposure through national campaigns, which can reduce individual marketing costs and increase international bookings. So that is also on the plus side. Stakeholder collaboration. Hotels are part of a broader tourism ecosystem. Collaboration with Essland enables strategic partnership, access to data, a very important area, and alignment with the national tourism goals. This supports stakeholder engagement, which is our key SBL theme, especially in managing public and private relationships. Then operational benchmarking. The use of standardized inspection criteria allows hotels to benchmark their service against national expectations, not just a primary localized area. And this could be linked to, or all of these rather, could be used to balance the challenge provided by the new emerging trends such as Airbnb, etc. The use of standardized inspection. Okay. Risk mitigation. Alignment with Visit Estland standards helps mitigate reputational and compliance risk. It also provides a buffer against regulatory uncertainty as hotels operate within the recognized framework and they would have a already being inspected by a government organization. With this, we come to the levels overview. Overall, what is this organization about and what are the different areas that it goes through? Well, it operates 35 four-star hotels and uses a unique non-standardized design reflecting local history, contrasting with the standardized approach of large chains. Now, this could be an issue with us. While this enhances the exceptional experience mission, which is one of our mission statements, it increases operational complexity and cost because maintenance and refurbishment in every area will be different because they are operated differently. So we may not be able to have economies of scale per se. So if all 35 hotels are completely different, obviously that is not possible. There would be variations. So there will be a problem for economies of scale in this area. Our model is we are a listed company, and with this we will have governance requirement, but we will see are worked out quite well. 80% by the institutional investors. It uses owner managed model. Uh, Implication is that being listed creates significant pressure from consistent long-term growth and accountability to institutional investors. In the board, we have 5 executive directors and 4 non-executive directors, which is quite a good balance, plus a non-executive chair. Uh, okay, so in total, it would be 5 to 5. So we could say 5 to 4 or 5 to 5 ratio, excluding chair, suggests a strong executive presence and the potential dominance over uh, strategic decision making. It also has audit committee, nominations committee, remuneration committee, and risk committee, and it also has a proper audit department which reports to audit committee on different risk areas as well. What is their overall strategy and revenue constraints? Pricing, food and bar, and operational efficiency. They have a mix of revenue. Room service is providing 62% and food and bar is 33%. But there is an issue that food and bar is only allowed to the hotel guests. And this could be an area where we are lacking possible income stream. Others is 5%. F&B margins are lower than room revenue margins. Restaurants and bars serve only hotel guests. So this policy severely limits food and bar revenue potential and asset utilization, especially when F&B contributes to the third of the income. And if we could open it to the outsiders as well, which are not staying in the hotel, that could also give us a possibility of increasing our revenue in the off seasons as well. Demand peaks from October to March, coinciding with higher ADR, and dips in the summers, which is from April to September. Head office sets prices annually. Local managers have the limited authority to discount to up to 70 only during off-peak seasons. That is also an issue. This limited only non-dynamic pricing control puts Levwell at significant competitive disadvantage as it fails to employ the sophisticated yield management techniques which we have already discussed. Okay, what are the different activities that are performed and a detailed analysis on these? First is obviously reservation and booking. Guests book accommodation typically via website or telephone and verify prices or availability. It uses an integrated company-wide system which is based on their own servers to coordinate bookings in real time. The website includes room summaries and facilities. Here is it. We have a technology risk, reliance on systems availability and security for all booking and payments, potential failure to comply with regulatory requirements regarding guests' data, and there could be other risks if you are not using state-of-the-art softwares and data analytics. Check-in is at the reception. Staff verify the guest details, process payments, and provide room access keys. All of this is done at the manually, and staff again is an issue. For telephone bookings, guest details are still entered manually. Staff must receive regular customer service training because of the turnover. Obviously, here we have a reputation risk. Manual entry for telephone bookings may be slower, undermining the guest experience of speed and convenience, which is one of the aims expected from a modern technology. People risk high employee turnover, 39 to 41%, threatens staff consistency and training quality, which will affect the guest experiences. Then another service is housekeeping, cleaning and preparation of rooms for the guest, common areas, ensuring cleanliness and quality, which is obviously required to be very high considering we are a 4-star hotel. Follow standard operating procedure for consistency. Laundry services, washing bed linen, towels, etc. are outsourced to a third-party company. High staff turnover makes adherence to complex SOPs difficult, directly threatening the quality and cleanliness which is required of a 4-star rating. Supply chain risk, when you're dependent on third party, reliance on outsourced laundry introduces risk if the third party fails to meet the quality and delivery schedules. Maintenance, we ensure all hotel infrastructure, plumbing, furniture is in good working order. We use an in-house team for routine maintenance, and 35 hotels are non-standardized design. So that could create an issue of rising costs. Non-standardized design likely lead to higher maintenance and refurbishing costs compared to chains using standardized models. Maintenance failure leads to reduced quality and guest complaints, obviously. The process of providing food and drinks contributing 33% of Levwell's total revenue. Catering services are constrained as restaurants and bars only open to staying guests. Procurement prioritizes locally sourced seasonal ingredients and checks supplier environmental credentials. So that is good for the sustainability. But the constraint of serving only hotel guests represent a significant lower revenue opportunity and poor utilization of physical assets. Reliance on local seasonal ingredients creates dependency on and potential vulnerability to regional crop failures or supplier shortages. And obviously, that may not give you a competitive advantage, and the suppliers may also uh, give you, excuse me, give you an issue in that area. Okay. Now, what is the technology and risk profile of Levwell? It uses integrated hotel management system (HMS) or IHMS for real-time coordination of reservation, maintenance, and keeping via a mobile app. Levwell's IT systems are hosted in in-house servers and do not use cloud computing services. Now, this could provide a good tool for lesser security breaches, but the flexibility and scalability options of cloud computing, we are lacking in that. This decision increases exposure to technology risk uh, and data security risk. Well, it is arguable. In-house systems are harder to scale, to expand, protect, because yes, within if you are in-house servers, if they are connected to internet and then you do not have that much level of IT skills within your organization to deal with all kinds of cyber threats, that will be an issue. But if it is not connected to internet and it is connected within the hotels via a wide area network or local area network, then that possibility could be reduced. But considering that nobody uses those systems anymore and internet is a requirement, and on top of that, we have a website, so we will have exposure to internet. So that does provide a data security risk and technology failure risk as well, and maintain the professional cloud solutions. Now, what are the different risks which are identified? People, reputation, competition, pricing, and technology. Throughout different areas, we have gone through these. So, failure to attract, retain, and motivate staff, that is a major issue. And I would say that this is one of the top or leading issue, as it is dealing with it leads to all other further issues. Reputation, failure to provide high quality experience, damaging bookings, and failure to respond to changes in the market, finding optimal room price, and technology and data security. These are the areas which are highlighted. Their mission is to provide exceptional experience for the guests, but with higher turnover, that will be very, very challenging and is rather more very challenging for the organization to keep up with. Their core value is to provide a first class service to the people, but there is a contradiction. The severe people risk noted above directly conflicts with the mission and the value of first class service. If staff is not retained and motivated, service quality will inevitably fail. Our overall financial performance in KPIs, revenues, we have a consistent growth, 182 million to 229 million. It's positive, indicates successful market penetration and pricing strategy to date, but with the continuing challenges, that is going to be an issue. We are stable in the operating profit margin, improving 13.52 to 14.1%. Level performs above industry standard of 10%. And this is the financial performance area that could be tested. Good control, cost control, and effective premium pricing relative to competitors. But will this go on in future with others working on new type of technologies and data analytics and having a uh, flexible pricing structure? Strong upward trend, 121 to 136, confirms growth in efficiency driven by strong pricing and stable occupancy. High and stable are guest satisfaction, 4.2 to 4.4 out of 5. Now, this seems a little bit off. What are the possible areas? Why is this such a high standard? Now, it seems that there is some area which provides uh, some input which is not provided here, and we could expect that from in the paper and on the exam day, that with the such high turnover, and we are saying that it is the people risk is quite high, and it is because it is a service based industry with such a high turnover, people turnover, staff turnover, we will be always at risk. Then what could be the possibility of these high ratings? Maybe the services that are available, or the room facilities that are available, or the areas, localities that they are focusing on are very attractive for the customers. The current strategy based on high quality, non-standardized design is working well for the guests. Employee turnover critically high and stable, 41% down slightly to 39%. This is a major red flag. Extreme staff turnover rate is costly and represents a critical failure. So even if all of the other margins are good, this is a drain on our revenues, and this is critically damaging us. And this would be and I would suggest that this would be a major area where we will have to look into and suggest strategies to improve in this area. It possesses an imminent threat to sustaining the highest guest satisfaction score over a long term, creating massive strategic gap. Okay, so concluding everything, Levels PLC finance currently it is a financial success and delivers high quality service. We have a people service paradox, mission of providing exceptional services. It is directly threatened by chronic 41% employee turnover rate. It is unsustainable to deliver first class service in the long term. Technological lag, we are relying on in-house servers, and that is providing and exposing us to excessive operational and data security risk, while lack of dynamic yield management limits revenue optimization in highly competitive environment. Untapped revenue areas, food and bar service only to hotel guests. This is a major area we will have to look into, and you could be asked to devise a report on how we could improve on that. So our challenge is not performance, it is resilience. Whether we will be able to continue with this in future, obviously not. So what could be there in the bag for us on the exam day? Well, let's see. I wish you all the best for your upcoming examination, and I hope that this has been a very helpful session for you to overcome the different areas of this pre-scene. Thank you very much. Take care. Good luck and goodbye.